Hi, I'm Steve Breen with Prosperion Financial Advisors. We believe it's imperative for investors to understand the difference between volatility and risk. Though often used synonymously, these are two distinct concepts. We think your success can be increased by clearly understanding the distinction between these two principles. So let's start taking a look at risk. We define risk as the loss of purchasing power of investors' capital over time. This accounts for more than simply the math or the growth of investors' money, say from $100 to $110. It also needs to account for the loss of purchasing power of that money over time, which is due to inflation. You see, over a period of 10 years with a 3% inflation rate, that nominal $110 would actually be worth less than the $100 investors started with 10 years ago. So often investors consider only half of this equation, the nominal return, without accounting for the risk associated with inflation or the loss of purchasing power. This is a very challenging experience that all investors face. When money sits in a bank earning less than 1%, as it has recently, wealth doesn't increase. Instead, the true value of that money actually decreases over time at 2 or 3% per year due to a 2 to 3% inflation rate. Make no mistake, when your money buys you less goods and services over time, it's a risk to your long-term financial success. Volatility is, on the other hand, that cyclical up and down movement of market prices. It's the wiggle that the market has and always has and will have. We consider volatility to be a normal and necessary piece of investing, and it shouldn't be feared, nor should it cause panic. Yet in our experience, investors often get scared out of intelligent investments or their long-term financial plan by doing or by reacting to what the markets may be doing temporarily. It's easy to understand why everyone would like less volatility, if that's all there was to it. But when you decrease volatility, there's a serious negative consequence. In our experience, low volatility leads to lower returns. And lower returns necessitates one of three things: either more money, more investment principal, lower withdrawal rates, or you simply run out of money. Consider the historical data of three asset classes: large companies, small companies, and bonds from 1926 to 2013. There are four numbers to remember: 12, 10, 6, and 3. Small companies have had an average return of 12%. Large companies, 10, bonds, 6, and 3 is the typical inflation headwind. Now we subtract 3 from each of those nominal returns to bring the real return after inflation to be 9, 7, and 3% respectively. The rate of return an investor experiences is often directly inverse to their desired levels of volatility. Bonds wiggle less than stocks, so they often have a lower return than stocks. Those who are willing to ride the roller coaster experience higher highs and lower lows than those who want to stick around and be more flat, like a merry-go-round, like the bond market. Well, less volatility means less return. Less return means either you have to work longer or spend less or run out of money before you run out of time. So what's an investor to do? Well, let's start by keeping in mind 6 points. Number 1, volatility is merely a synonym for unpredictability. Volatility simply refers to the relatively large and unpredictable movements that the equity markets have above and below their permanent long-term upward trend line. Number 2, the premium return of the equity market is therefore the efficient market's way of pricing in adequate compensation for tolerating that unpredictability, paying investors for that unpredictability. Number 3, seeking less volatility leads to a commensurate less return. Number 4, think about equities and their permanent advance, yet temporary decline asset class. Now that's a bold statement, but based on history, it's true. And if you have a long enough time horizon, the markets have historically always gone up. Denying this is the equivalent of saying, well, this time it's different, which it never has been. Number 5, If you're accumulating investments, you should applaud volatility because you're continually, systematically buying more shares when prices are high. You're buying fewer shares when prices are high and more shares when prices are low. Number 6, I think there are some investors who are harmed by volatility, especially those who are approaching retirement or just in retirement. And we have investment strategies to help bridge that 1 or 2 year period with low risk cash strategies. Volatility is in no way synonymous with risk. In a properly diversified portfolio, those declines are temporary, and what we try to do is manage through that. The key is finding the balance, the appropriate level of volatility versus locking your money away and having it erode in purchasing power over time. We seek to find that right balance for our clients and putting their money to work. If you'd like more information or would like to discuss some of our investment strategies, we would be delighted to have that conversation. Thank you for being a client of Prosperion Financial Advisors. I'm Steve Breen.